Yo, what's up? So this video is a breakdown of what shares, ownership, and equity mean in the context of a stock. What are shares? A share is a single unit of ownership in a company. Companies issue shares to raise money. When you buy a share, you essentially buy a small part of that company. Here go an example. If a company has 1 million shares in total and you own 10,000 shares, you own 1% of that company. Now imagine you own, let's say your job has, let's say 10,000 shares and you own 1,000 shares of your job. Let's say you work at UPS. Now that would be really cool, would it? And they pay a good dividend. All right. So next, what is ownership? So ownership in a company means having a claim on part of the company's assets and earnings. Through shares, owning shares equals owning a portion of the company. Rights. Shareholders often have rights such as voting on major decisions like electing the board of directors, receiving dividends if the company distributes profits, a claim on assets if the company is liquidated. All right, here go the next one. Equity. What is equity? Equity refers to the value of an owner's interest in the company. In stocks, in the context of public companies that IPO'd on the stock market, meaning they're on a public stock exchange, equity typically refers to shareholder equity, which is assets take away liabilities. It represents the net value of the company that belongs to its shareholders. Market value. The market equity or market capitalization is share price times total shares outstanding. It reflects what the market thinks the company is worth. Now, overall, here go a little quick summary. Shares are the individual units. Ownership is what you gain by holding shares. Equity is the value of that ownership. All right, here go a bonus definition. Liquidation. What is liquidation of a stock? So liquidation of a stock typically refers to selling off stock holdings for cash, or in other words, converting your shares into money by selling them in the market. However, the term liquidation can also apply in a broader corporate context, especially when a company is shutting down. Number one, for investors, individual context, liquidating stock equals selling your shares. Now, why does it happen? Investors may liquidate for various reasons. First one is to take profits. The second one is to cut losses. The third is to rebalance their portfolio. And the fourth, they just may need cash. Here go an example. If you own 100 shares of Apple and sell them on the stock market, you've liquidated your position, basically turning your shares into actual money. Number two, for companies, corporate context, company liquidation means when a business shuts down and sells all its assets to pay off debts. Impact on stockholders. The company assets are sold, debts and creditors are paid first. Shareholders are last in line. They may get something, but often they get nothing if liabilities exceed assets. Result, the company's stock becomes worthless and it's removed, delisted from the stock exchange.